Welcome back to the deep dive. You came to us curious about Build on Tuna, or TUNA, and for good reason. This is a project that's not just, launching another token on Solana. It's trying to fundamentally overhaul the entire structure of how those launches even happen.
That's right.
Yeah.
And if you have spent any time in the Solana ecosystem, you know it's a place of just incredible innovation, but also one where trust is constantly being tested.
Oh, absolutely. The fear of immediate insider dumps, the outright rug pulls, that's a huge problem.
It is. And we have the internal analysis here, a detailed stack covering their strategic roadmap, their white paper, their competitive stance. And what it shows is a project trying to solve a trust problem with architecture.
Before pivoting into the, frankly, extremely high-stakes world of leverage trading.
And that is the essential tension we need to explore. This deep dive is about understanding how a protocol can promise, on one hand, this unprecedented level of investor protection, while simultaneously expanding its core functions to include risk profiles as aggressive as, 125x leverage.
Yeah, that's a huge leap. This isn't just a new token model.
No, it's a proposed foundational re-engineering of the market structure itself.
Okay, let's unpack this. Our mission is surgical. First, we need to identify that core structural differentiator, that protective launch mechanism.
Right.
Then we'll dissect the economic engineering that fuels it, digging into the TUNA tokenomics and what they call the revenue flywheel.
And then the big pivot.
And then we absolutely have to spend time on their ambitious near-term pivot into high-leverage DeFi and their long-term vision of becoming the default foundational layer for all tokens launched on Solana.
It's a journey from a safety net to a high-wire act.
Exactly. And we need to examine every single anchor point.
We absolutely do. And like you said, we have to start with the core problem Build on Tuna is trying to solve.
A toxicity.
The toxicity of initial token offerings on Solana. The ecosystem often feels plagued by those two trust killers. The instant post-launch dump, where the earliest buyers just sell on retail within minutes.
And then the project team just vanishes.
And the outright insider rug pull. Building an architectural solution to those problems is, their initial mandate.
So let's jump straight into what makes their solution so unique. Let's begin with the project's identity. I mean, it's called the Launchpad, but based on all this material, that description feels, a little reductive.
It is. It is a Solana-based launchpad, yes, but it functions more as a mechanism designer.
A mechanism designer. I like that.
Its core purpose is to revolutionize token launches, and they're starting with the high-volume, high-risk Memecoin space. And the critical technical foundation for this is the use of a structured bonding curve mechanism for price discovery.
Okay, so let's break that down. A traditional launch usually uses an automated market maker, an AMM, to set the price. How does a bonding curve offer, superior price discovery, especially in these really high-demand launches?
An AMM pool, especially a brand new one, is just inherently brittle. The price is determined by a simple ratio of two assets, say SOL and the new token.
Right.
So if one massive buyer comes in and sweeps up a huge chunk of the new token, the price just skyrockets instantly. And the slippage for all the smaller buyers after that is immense.
And the liquidity is paper thin at that point.
Exactly. It's often very shallow, which allows insiders to dump their tokens back into that thin pool with just a devastating impact on the price.
And the bonding curve is meant to solve this by making the price progression controlled.
Precisely. The structured bonding curve is demand-driven, and it's programmatic. The price is determined by a preset, algorithmically defined curve. It dictates the price increase based on the total amount of capital invested into the pool, not just the last trade.
Ah, okay. So it's about the total volume, not just one single transaction.
Yes. This creates a much more controlled, incremental, and visible price path during that initial launch phase. It distributes the supply over a predictable curve, meaning a single large purchase won't cause that same instantaneous spike or collapse. The price just moves slowly and deliberately up the curve as funds enter.
This controlled entry is just the first step, though. Here's where it gets really interesting. And this is the structural answer to that trust crisis we were talking about. The innovation of the zero-loss exit.
This is the centerpiece of their entire thesis.
It has to be.
And it's encapsulated in the 60-minute exit protection window. And I want to be clear, this is not some kind of gentleman's agreement.
Yeah.
It's a hard technical guarantee written directly into the launch smart contract. It's enforceable on-chain.
60 minutes. Why that specific duration? And what does zero-loss exit actually mean in practice for a user?
The 60-minute period is a window of controlled risk assessment. During that time, early participants who get cold feet Maybe they see slow adoption, maybe a lack of community engagement, or they just detect something weird. They can exit their position.
And they can't lose money.
They cannot sell at a loss. They receive a zero-loss exit that returns their principal investment.
Okay, we have to be precise here. It returns the capital they put in, but what about gas fees?
Right. It returns the capital they committed to the bonding curve, but standard Solana gas fees, which are minimal but still required for the transaction, are not covered. But your core investment principal is protected.
That is a bold architectural commitment, but let's play devil's advocate because we have to push on these mechanics. Where does that guaranteed principal actually come from? If I put in 100 SOL and the price drops because of some selling, and I ask for my 100 SOL back, who pays me? Who's the counterparty?
That is the critical technical detail to focus on. The protection relies entirely on collateral that's locked within the launch contract itself.
Ah, okay.
When a new token launches through Build on Tuna, the protocol mandates that a significant reserve of collateral, we're talking likely stablecoins or highly liquid assets like SOL, is locked alongside the token supply.
So the risk of loss is immediately shifted from me, the early participant, to the launch platform's treasury, or maybe to the reserve capital put up by the token creation team.
Precisely. It's a collateralized downside protection. If a participant exits during that 60-minute window, the smart contract just taps into that locked collateral reserve to refund their principal investment.
Which means the protocol or the team launching the token, they have to be structurally sound and well collateralized to even offer this guarantee in the first place.
Yes. It shifts the risk from the individual retail buyer to the protocol's structural integrity.
That dramatically alters the psychological dynamic of participating in a launch. The immediate fear of being dumped on and losing half your investment in the first 5 minutes. It's structurally mitigated for that first hour.
Absolutely. It removed the necessity of frantically trying to front-run other participants.
Right.
You are actually incentivized to participate in this initial controlled phase, knowing you have a window to evaluate the project's true merit without extreme financial penalty.
So after the 60 minutes are up, the training wheels come off. What happens to the tokens then?
The 60-minute phase is a controlled gate. It's designed specifically for trust building and initial price stabilization. Once that lockup expires, the tokens immediately transition to open market trading on decentralized exchanges, on DEXs.
So the liquidity just moves over.
The liquidity created during the bonding curve phase is shifted to standard AM pools. This creates a really clear funnel. You move from a highly controlled, high-integrity protected environment into the normal, volatile, open market dynamics.
It's a staged rollout. You establish legitimacy before you subject the token to the Wild West of the open market.
That's the idea.
This brings us directly to the structural mitigation of risk. If this only lasts for 60 minutes, isn't the team just delaying a rug pull until minute 61? What stops that from happening?
That's the right question to ask. And to answer it, we have to analyze the structural constraints placed on the insider teams themselves. The bonding curve system, combined with that mandatory exit protection, makes it structurally impossible for insiders to immediately dump their tokens on new buyers during that crucial initial period. But more importantly, the sources suggest that the team's own allocated tokens are subject to stringent, protocol-enforced vesting schedules that extend far, far beyond 60 minutes.
So it's a multi-layered solution, protection for the buyers and mandatory lockups for the sellers.
Yes. If a team can't dump their tokens immediately, and they know participants can pull their capital without penalty if the project looks shady, the whole risk calculus changes. This protection aims to establish new standards for token launches by penalizing projects that generate low interest or distrust right out of the gate.
So it basically mandates a successful, trustworthy launch if the team ever wants their long-term vesting to be worth anything.
Exactly. If the project is immediately seen as a dud or potential rug, participants pull their capital, the reserve is used, and the token's trajectory is just halted, minimizing the widespread damage.
For you, the listener, this is really the core aha moment. We are seeing structural engineering being applied to a trust problem, offering a concrete downside protection that challenges the very nature of speculative risk in this sector.
And if Build on Tuna achieves widespread adoption, they could force a systemic change in how projects have to launch on Solana.
Okay, so that's the foundation of trust. But that trust needs to be supported by a solid economic model.
Right. And if the launch mechanics are the foundation, the TUNA tokenomics are the economic engine that has to support and reward that trust long term. So now we move to the revenue flywheel they've designed for sustainability.
Let's get granular on the supply and allocation figures. I think we need to understand the intent behind these numbers.
The TUNA token operates on a fixed 1 billion total supply. That's a hard cap defined right in the sources. And the allocation breakdown, it reveals a deliberate focus on supporting that initial launch environment over, say, immediate open market liquidity.
Walk us through that split.
Okay, so 80%, that's 800 million tokens, are allocated specifically for the bonding curve. That's the mechanism that governs all the initial token creation activity. The remaining 20%, or 200 million tokens, are allocated for the DEX liquidity reserve. And that's crucial for supporting the post-launch trading when the tokens move to the open market.
80% for the bonding curve. That seems really disproportionately large. Why so much?
This is actually a structural defense mechanism.
Yeah.
By dedicating 80% of the total supply to the curve, they ensure immense depth within that controlled environment.
Okay, so it's about capacity.
It is.
Yeah.
If they allocated, let's say, 50% high initial demand, could just rapidly exhaust the curve supply. And this would force the token to prematurely transition onto the unstable, thin DX market, which would nullify the price control and stability the curve was designed to provide in the first place.
So the 800 million tokens make sure that even huge initial institutional level demand can be absorbed gradually and systematically, maintaining the integrity of that 60-minute window.
That's the plan.
So the vast majority of Tuna is collateralizing and facilitating the safe creation of new assets. That makes sense for a launch platform, but how does this translate into long-term value for the Tuna token itself? We need to look at the platform fee structure.
The sustainability model relies on a very modest ongoing revenue stream, a 1% platform fee per trade.
1% is genuinely modest. I mean, compared to what we see in some other DeFi protocols, that's pretty low. Is that a strategic choice?
Absolutely. The sources really emphasize that the 1% model is deliberately modest to encourage widespread adoption. The calculation is simple. Higher volume at 1% generates more revenue than low volume at 3%.
Right, makes sense.
If the fee is low, more token creators will choose build on Tuna over competitors, and more traders will use the platform's eventual leveraged products. That volume is the key.
And crucially, where does that fee revenue go?
This is the critical mechanism for aligning long-term incentives. The revenue gets distributed to two key groups: the original token creators, which gives them a sustainable model, and, more importantly for TUNA holders, to existing TUNA stakers. This is the definition of that sustainable flywheel we mentioned.
Okay, so let's define that flywheel clearly. How does this cycle gain momentum and become self-reinforcing?
So a flywheel is a virtuous cycle, right? In this case, it works like this. The low 1% fee attracts high volume from both new launches and leveraged trading.
Okay, high volume.
That high volume generates substantial fees. Those fees increase the staking yield for TUNA holders. The increased yield then incentivizes more users to stake and lock their TUNA, which secures the protocol and provides deeper collateral pools for the leveraged products.
And that enhanced security and liquidity enables the platform to support even more volume, which feeds right back into the start of the cycle.
Exactly. The token holders move from being passive beneficiaries to active economic partners in the system.
That explanation really clarifies the interconnectedness. The token's value isn't just speculative. It's intrinsically tied to the platform's adoption and trading volume across two very distinct products: launches and trading.
Correct. The system requires constant flow, and the token holders are the primary recipients of that flow.
Now, before we dive into the pivot to leverage, we absolutely have to clarify the distinction between Build on Tuna and DeFi Tuna. They seem to operate in the same orbit, but they serve different purposes.
This is a crucial distinction to make. Build on Tuna is the launch environment. It's the front gate where new tokens originate using that protected bonding curve. It's all about integrity and initial distribution. DeFi Tuna, on the other hand, focuses purely on liquidity provisioning and leveraged yield strategies for existing token holders. It's a set of financial tools you apply after the token is already launched.
So one builds the car, and the other offers leverage financing to trade the car.
That's a really good analogy. They are separate protocols with distinct functions, which minimizes confusion for the user. And architecturally, separating them is smart. It isolates the risks.
Right, so a problem in one doesn't immediately kill the other.
Exactly. If a high-leverage trading product on DeFi Tuna experiences some kind of exploit, it doesn't immediately compromise the integrity or the collateral reserves of the launch mechanism on Build on Tuna. This minimizes the systemic risk within their whole ecosystem.
Okay, we've established the structural integrity of the Launchpad. But as we move into the near-term roadmap for 2026 and Q1, the protocol is shifting from risk mitigation to, well, risk attraction.
That's a good way to put it.
This is the aggressive pivot, and it's massive.
Okay.
The integration of perpetual leverage trading.
This is a significant strategic move. It transforms TUNA from a specialized launch mechanism into a direct competitor in the derivatives market. They're aiming to capture a large share of the high-volume perpetual trading market on Solana.
So let's address the elephant in the room immediately. The maximum leverage exposure they're targeting is staggering.
The sources are unambiguous on this. They're introducing perpetual trading functionality for Solana tokens, with leverage exposure of up to 125x.
125x, that's an extremely aggressive figure. It places them in the highest tier of available leverage across the entire DeFi landscape.
It's a bold claim, and it implies they're very confident that their back-end infrastructure can handle the extreme volatility and rapid liquidation required for a network as fast as Solana.
So walk us through the infrastructural demands this creates. What needs to be perfect for 125x leverage to not just blow up?
Several things have to be perfect all the time. First, you need low-latency Oracle feeds. For 125x leverage, your liquidation price is literally milliseconds away from the current market price.
Right.
If their price feeds, which they'd source from providers like Peth or Chainlink, have even a brief delay or an inconsistency, liquidations can be triggered inaccurately or too slowly, and that jeopardizes the entire collateral pool.
Meaning the system could fail to liquidate the losing trader quickly enough, and the losses get socialized, hitting the stakers who provided the collateral.
Precisely. Second, they need an incredibly robust liquidation engine. This is a highly specialized piece of infrastructure. It has to be efficient, scalable, and capable of executing liquidation transactions almost instantly on the Solana network, which often requires using priority fees to ensure immediate processing, even when the network is congested.
Any failure there directly threatens the collateral provided by the TONA and social holders.
It does.
So who is actually absorbing all this risk? Who's providing the counterparty liquidity for these highly leveraged trades?
This is where the TONA and social holders play their vital role. Users will stake their Sol-Lars or their TONA into dedicated liquidity pools that function as the counterparty. They become the decentralized margin provider.
And the reward for staking, for taking on this tremendous risk.
Stakers receive a proportional share of all the trading fees generated across the platform. This is the second revenue loop, and it's designed to drive exceptionally high yield potential. If the 125x perpetual market captures significant volume, those fees could potentially dwarf the token creation fees, generating very compelling rewards for the holders who secure the platform.
Now, we did note a bit of a contradiction in the sources. This aggressive 125x figure versus some earlier technical discussions that reference development of up to 5x leverage capabilities. That gap is massive.
It is.
How do we interpret that? Is it a phase leverage rollout?
It suggests prudent development, starting with 5x leverage capabilities, which would likely target concentrated liquidity pools backed by TVNA collateral, serves as a calculated beta test. They can prove the fundamental infrastructure, the Oracle security, the liquidation engine, at a relatively safer tier.
So they start low, prove the mechanism is secure and stable, and only then do they scale toward the higher risk, higher reward 125x tiers.
Yes. It indicates the team understands the gravity of this technical undertaking. Scaling from 5x to 125x is not an incremental change. It requires fundamentally different risk parameters, higher capital requirements, and a near-zero tolerance for error. The phased rollout demonstrates a pathway to execution, not just a maximalist dream.
And alongside this massive technical pivot, they're implementing structural decentralization through tokenized governance. This seems essential if they want to be taken seriously as a foundational layer.
It's foundational. The move toward decentralization is critical. The implementation of tokenized governance is rolling out to ensure that the risk of the platform is managed by its stakeholders, not just by a centralized team.
Who specifically gets the power in this new structure?
The sources specify that the top TUNA holders receive voting rights on critical protocol decisions. This concentrates decision-making power among those who have the largest economic interest and are therefore most aligned with the protocol's long-term stability and success.
And what's the scope of their decision-making? What can they actually vote on?
The scope is extensive. It covers the economic heart of the platform. So this includes voting on parameter changes, like adjusting that 1% fee structure, maybe if volume is high enough, reducing it to 0.5% to attract even more traders. It also includes adjusting Tuna emission schedules and, crucially, directing future feature roadmap priorities, like the deployment of new lending modules.
So this mechanism serves as a decentralized check on power, forcing the dev team to align their interests with those who have locked the most capital into the ecosystem.
Precisely. It creates decentralized decision-making, which in the long run builds much greater institutional confidence than a centralized structure.
Finally, let's look at the enhanced staking and yield generation utility that supports this whole governance model.
Right. So beyond just getting a share of fees from trades, they're developing an enhanced staking rewards infrastructure. The utility of locking your TUNA becomes twofold. Community members can lock TUNA for governance participation and for layered yield generation. Locking supply reduces market selling pressure, it stabilizes the token, and it ensures that the most dedicated community members receive higher staking rewards, potentially in the form of boosted APYs or reduced trading fees on the Perpetuals platform.
And the specifics on APY are still to come.
The specific APY mechanics are still pending the formal roadmap publication, but the intent is clearly to make TUNA a high-utility, yield-bearing asset that's central to all operations.
Okay, so moving from the immediate pivot to the distant future, the grand vision.
Yes, now we analyze the architectural ambition. And the goal is to position TUNA not just as a successful DeFi protocol, but as the foundation layer for the entire Solana token economy.
That is a tectonic shift in focus, moving beyond solving the Memecoin problem to becoming the standard bearer for all launches. What does the team even mean when they say they want to build core infrastructure for all token launches on Solana?
It signals a fundamental expansion of scope. If they are successful, their launch mechanism, that bonding curve with exit protection, becomes the mandatory accepted standard. They're moving into enterprise-level infrastructure. The phrase they use, build an ecosystem that fully understands the mission, implies they want to be the trusted gateway for serious, long-term tokenized ventures, not just speculative assets. And this means enforcing structural security and integrity standards across the board.
Okay, let's structure this ambition by reviewing the 4 strategic pillars that seem to define their long-term vision. Pillar 1 is market structure transformation.
This is the legacy of their initial design. By successfully enforcing the bonding curve and that 60-minute exit protection, the long-term impact is profound. You're reducing the viability of predatory launches and establishing new, trust-mandated launch standards across the entire Solana ecosystem.
So the ultimate goal is to establish a market filter where any token that doesn't use a protected launch mechanism is instantly viewed as higher risk and struggles to attract capital.
You force trust through structure.
Exactly. If the architecture changes the incentives, the financial model has to evolve to support it. So, pillar 2, revenue diversification. This is about evolving from a point solution to a comprehensive financial platform.
This really defines the maturity of the ecosystem. As we discussed, they're moving far beyond a single stream of income. The sources identify 4 distinct sources of fee flow that will sustain and grow the platform, each targeting a different part of the user journey.
Let's detail those 4 sources because their cumulative impact is really the key to their long-term financial success.
Absolutely. So first, the foundational layer. Token creation fees. These are the 1% fees generated when new projects use the launch mechanism. This is the trust-based revenue.
Okay, number
1. Second, the high-volume engine. Leverage trading fees. These are the fees from the 125x perpetual market, and this is expected to be the largest source of revenue due to high volume and high churn.
Right, and third.
Third is the eventual module expansion. Lending interest. Once their liquidity is sufficiently deep, they can offer lending and borrowing services, generating interest fees on all that locked collateral. And the fourth source.
The fourth is staking participation fees.
Exactly. This is the structural support fees generated from users locking TUNA for governance or for yield boosts. And if you connect the dots, leverage trading fees, being the highest volume generator, are expected to provide the majority of the yield, which in turn drives staking participation, which secures the platform for both lending and launches.
So it's an interconnected ecosystem where the high-risk volume actually subsidizes the low-risk launches.
Precisely. It's a highly integrated revenue strategy, which is the hallmark of a true foundational layer.
Which brings us to Pillar 3, which focuses on governance maturity, community-owned governance.
The long-term state here is essential for decentralization. They aim to position TNA token holders as the de facto stakeholders in the protocol's evolution.
So what does that mean in practice?
It means, if they succeed, the protocol will reach a level of critical decentralization where major capital-intensive decisions, like allocating treasury funds to new acquisitions, setting risk parameters for the leverage pools, or determining which established DeFi protocols to integrate with, all of that flows through token voting.
Full alignment with the ethos of Solana's decentralized infrastructure.
Yes.
And finally, Pillar 4, and this is one that determines their survival in the competitive Solana landscape. Integration with the existing DeFi stack. They have to play nice with the giants.
Composability is the law of the land on Solana. The perpetual trading and lending components clearly suggest planned partnerships or deep composability with existing Solana DeFi primitives, and the source is specifically meant in integration with protocols like Orca and Marinade.
Orca is a major player in concentrated liquidity, and Marinade is essential for liquid staking derivatives. What does integrating with them look like practically?
Well, it suggests they won't build everything from scratch. For example, they might use Marinade's liquid-staked SOL, MSOL, as a preferred collateral type within their leverage pools. This would immediately give their stakers exposure to a proven yield source while securing their own lending module.
And with Orca.
With Orca, integration might mean leveraging Orca's concentrated liquidity pools for efficient market making after a token launches, or even using TNA collateral to bootstrap new, highly efficient trading pools on their platform.
So the ultimate goal isn't to replace the existing DeFi rails, but to become the mandatory on-ramp.
Exactly. To become the default entry point and exit mechanism for token launches, directly integrated with established DeFi rails. If you want a secure launch, you use TUNA. If you want to maximize yield or leverage on your TUNA or the token that just launched, TUNA facilitates that connection using partners like Orca and Marinade. That's how a Launchpad evolves into a foundational layer.
Okay, we've covered the ambition, the structure, and the vision. Now we have to turn to the hard truth, execution and the inherent risks. Let's start with the positive execution indicators that suggest the team is capable of delivering on this monumental roadmap.
Right. We have verifiable evidence that the team is active and focused on sustainability and transparency. First, they have executed multiple confirmed on-chain buybacks. This is a powerful, visible signal of capital allocation being used to enhance the token's long-term economic stability and support the price.
Buybacks signal that the fees they collect are actively being used to reduce the circulating supply or improve liquidity, which is a key trust mechanism.
It is. Additionally, they secured a CoinGecko listing, which is, standard third-party validation that confirms basic market credibility and visibility.
And critically, what about governance?
We're seeing active governance feature deployment. Voting mechanisms are already rolling out, which means token holders aren't waiting for the entire DeFi suite to be finished before they start gaining decision-making power. And finally, just consistent communication through public messaging suggests a very professional approach to managing what will be a complex rollout.
That's the evidence of progress. Now, we absolutely must turn to the critical risks because the move into 125x leverage introduces entirely new classes of risk. This is the necessary due diligence for you, the learner.
The risks are profound, and they fall into 4 major categories. Let's start with regulatory uncertainty. This is an external risk. Regulatory clarity on leverage-based products remains, uncertain across various global crypto jurisdictions.
And specifically, which jurisdictions pose the biggest threat to a 125x product like this?
The high-leverage products are under intense scrutiny in markets like the U.S., where regulators have historically been very cautious about high-risk derivatives offered to retail users. If key jurisdictions decide to impose a leverage cap, say 20x, or even mandate KYC, it could severely restrict the high-volume market that Build on Tuna is chasing.
Which would immediately cut their most aggressive projected revenue stream.
It's a jurisdiction-by-jurisdiction battle they have to constantly monitor.
That external risk is significant. Internally, though, the most serious challenge has to be the operational risk related to these new high-leverage products.
This is the life-or-death risk for the platform. Leverage and perpetual trading require a fundamentally different risk model than simple Launchpad operations. The platform demands robust liquidation infrastructure and Oracle security.
We're talking about the difference between a minor technical bug and a catastrophic protocol-ending exploit.
That's right. If the Oracle system is compromised, or if a sudden flash crash causes the liquidation engine to seize up, the Tuna and Sol stakers who are backing the collateral could face massive, sudden, and irrecoverable losses.
The margin for error at 125x is virtually zero. I mean, a 0.8% price swing is enough to wipe out a position. The infrastructure has to handle hundreds of those events per second, reliably.
It demands an exceptional level of engineering and a capital commitment to security audits that is far beyond the scope of a typical Launchpad. The risk isn't just failure, but failure that triggers a bank run on the collateral pools, which would undermine the very trust they built with the zero-loss exit.
Third risk, let's address the timeline opacity.
This is purely a matter of managing expectations. While we have these detailed strategic outlines and technical discussions, the sources confirm that the formal, detailed quarter-by-quarter roadmap has not yet been publicly released, at least as of late December 2025. And while this doesn't imply incompetence, it does mean the actual pace of execution, particularly for the massive undertaking of building that 125x engine, remains an open, unverified question mark for the listener.
And finally, adoption dependency. This whole structure is a sophisticated volume machine.
Exactly. The success of that flywheel we analyzed hinges on achieving critical mass across both the token launch segment and the leveraged trading segment. If adoption stalls, if not enough projects launch through them, or if sophisticated traders just prefer established platforms like Mango or Drift, the fee-sharing models will generate minimal yield.
And that collapses the primary incentive for staking Tuna, potentially leading to supply unlocks and selling pressure. They need both trust-based volume and high-risk volume to make it work.
They do.
Okay, let's summarize the competitive positioning. How does Build on Tuna truly stack up against the established giants on Solana that also offer launchpads and derivatives?
The structural advantage remains the bonding curve, with zero-loss exit protection. That is their unique selling proposition. It's a structural innovation that directly addresses the core trust issues, first-mover advantage, and insider dumping that their competitors largely ignore.
And how does that distinction hold up against the likes of, say, Radium's Accelerator or Software Launchpad?
Radium and Software primarily focus on fairness of allocation through things like whitelisting, tiered systems, and auction mechanisms. They make sure you get a fair chance to buy the token.
Right.
Tuna, however, targets the structural integrity of the price discovery process and the protection of your principal. They're addressing the inherent risk of the launch model itself, not just who gets to participate.
So it's a difference in focus, from allocation fairness to principal protection.
And that's what positions Build on Tuna as a distinct and potentially higher integrity foundational layer candidate.
So to bring this all together,
Build on Tuna is currently executing a very difficult transformation. It's moving from an innovative, specialized launchpad built on trust and protection into a multifaceted DeFi infrastructure project that includes high-stakes, high-leverage trading.
And that initial foundation is critical.
It is. Their foundation of structural trust, the 60-minute zero-loss window, and the bonding curve is critical. But the key to their future is successfully executing the high-leverage trading modules. They have to transition into that high-risk, high-volume derivatives environment while maintaining the hard-earned reputation for integrity they established in their launch phase.
So what does this all mean for you? The ultimate success of Build on Tuna hinges entirely on whether its architectural solution can truly reset user expectations on Solana. Can it establish a new, less predatory standard for token creation that compels other launchpads and ecosystems to follow suit?
And if they succeed in attracting that volume.
Right. If they succeed, the highly integrated flywheel powered by fees from token launches, leverage trading, lending interest, and staking could make the Tuna token a uniquely valuable yield-bearing asset.
And this raises a profound question that extends far beyond just Solana. If Tuna manages to make the zero-loss exit the default expectation for new token launches, what larger effect could that have on the overall risk profile and even the institutional perception of the entire speculative market?
Could built-in safety mechanisms where the worst-case scenario is mitigated by design fundamentally change how speculative assets are viewed, traded, and even regulated?
If the architecture guarantees a form of trust, does that unlock entirely new pools of cautious institutional capital that previously avoided the chaos?
That is something significant to explore as you continue to watch this evolving space. That's all the time we have for this deep dive. We'll see you next time.